Every chart this week told the same story. Liquidity is thin and confidence is thinner. The S&P 500 trades at record valuation while liquidity sits at 5-year lows. Debt is exploding, politics are heating up, and the market feels numb to risk. Tonight, we are not reading headlines. We are reading the tape of global liquidity. From Fed's tightening cycle to Trump's tariff playbook, from gold's pullback to Bitcoin's silence. It's all one connected story of pressure building under the surface. Let's start with the valuation bubble everyone's pretending not to see. 19 out of 20 valuation metrics are above historical average. Price to sales, record. Market cap to GDP back to dot-com levels. Even forward earning multiples, which assume perfection, are stretched beyond 2021 highs. Markets aren't discounting earnings anymore, they are discounting fear. Investors know growth is slowing, but they also know sitting in cash feels wrong. That tension, that need to stay long and stay safe, creates bubbles that float until liquidity shifts. And that shift has already begun beneath the surface. The Fed's balance sheet is down $2.3 trillion from its 2022 peak. Reserve plus reverse repos are the real oxygen of the markets. They are now at a 5-year low. Liquidity is like the bloodstream. Prices are just the skin. And right now, skin looks healthy, but underneath it, blood is flowing very slowly. Money markets are yielding 5%, and QT quietly keeps pulling dollars out of the system. So when people ask, why isn't the crash here yet? The answer is very simple. Liquidity dies slow. Every cycle ends with the same illusion. Stability right before exhaustion. US just crossed $38 trillion in debt. That's $500 billion added in a month. 23 billion a day. In 5 years, $10 trillion was printed into existence. We are no longer managing debt. We are managing optics. Every dollar of interest now costs more than the national defense. This is fiscal dominance, where monetary policy serves the treasury, not inflation control. Think about it. How can the Fed stay tight when the government can't afford its own rates? Something will give, and that something is usually the dollar or the bond market first. At the same time, $7.5 trillion sit parked in money market funds, earning 5%. That's not risk off, that's waiting mode. It's cash that doesn't trust the rally, cash that refuses to chase valuations, cash that's preparing to rotate when confidence returns. Historically, big equity legs start when the capital leaves the sidelines. So the next bull run isn't about new liquidity, it's about recycled liquidity. When the rotation begins, the market's direction will change faster than headlines can explain, and politics might just be the trigger. President Trump has confirmed a face-to-face with Xi next week. The first direct contact since tariffs re-entered the conversations. Meanwhile, the US-China trade volume are down 18% year-on-year. In small packaging exports, the e-commerce artery have collapsed 50%. At the same time, all trade negotiations with Canada are frozen. This isn't just random diplomacy. It's the first move in the 2025 re-industrialization cycle. Trump is using tariffs as liquidity lever. Squeeze imports, redirect capital onshore, pressure rates lower. Markets are hearing trade war. Policymakers hear domestic stimulus. And once again, the short-term fear may fuel long-term inflation. Between all this, it's been 22 days into the government shutdown, the second longest in the US history. Jobless claims are up 121% week over week, the sharpest spike since 2019. This isn't noise, it's the first crack in the labor illusion. A tight job market can't coexist with fiscal paralysis. Sooner or later, policymakers will call this temporary. But temporary fiscal drag is exactly how recessions start quietly. September CPI lands at 3%. Core also flat, 3%. Flat, sticky, tolerable, but not falling. Now all eyes turn to events next week. FOMC meeting plus mega cap earnings. Apple, Microsoft, Meta, Amazon, Google, 5 companies controlling 30% of the index weight. If earnings disappoint, while the Fed stays firm, the markets face its first true liquidity squeeze of 2025. That week decides whether higher for longer breaks or bends. Gold's 9-week winning streak finally broke. Safe haven demand is cooling, not collapsing, just rotating. And Bitcoin still lagging equities, up 5.7% since January versus S&P 500 that's up 12%. Crypto isn't leading this cycle. It's following traditional liquidity. That means risk appetite hasn't fully turned. When Bitcoin starts to run, we will see it perform again. That's when you'll know liquidity has flipped from cautious to aggressive. Now look beneath the headlines and you'll see something new. The US government quietly taking stakes in AI and quantum. IonQ, D-Wave, Rigidity, Intel, Lithium Americas. That's not regulation, that's participation. Fiscal dominance has evolved into industrial dominance. The state is now both the referee and the player in the next tech cycle. The intertwining of government and innovation will shape liquidity distribution for a decade. Now let's look at some of the charts and see where we are in the market. So Nasdaq, S&P 500 and Dow Jones all trading at all-time highs. We have basically dipped down on the weekly discount on the impulse structure into this lovely fair value gap, swept the liquidity of this low and started rallying higher. The close of this week, ultra bullish. I am expecting a bullish week to carry on into next week as well. Let's see how the candle closes, but I would expect a retest of the previous all-time high and the market trying to go higher throughout the week. S&P 500, it's the same story. We have broken out of this narrow 3, and if we can sustain this move higher, I would say 7,000 is the easiest target that you're looking at. Looking at gold, gold had kind of a bad week, right? But when you have this sort of price action, one bad week does not define. I would really want to see gold go down towards the discount of this range. That will put us in a very good place, just below $3,900. I'm not saying we'll reach there. There are loads of inefficiencies in the markets right now. This fair value gap. I would say if gold tries to reach into this fair value gap, that would be a great buying opportunity again for new all-time highs. $5,000 gold, is that possible? In my mind, yes. Looking at Bitcoin, we are basically trying to trade higher. We have retested the neckline of this head and shoulders now quite nicely, and we are showing good price action above it. For me, to go long onto Bitcoin is basically very simple. I want to see a closure above 123,000 on the weekly time frame, and on the daily time frame, I want to see Bitcoin go close above the 115,000 area. This will offer me a nice change in state of delivery. This will confirm that the bullish trend is back on, but as of now, we are in consolidation, and that consolidation can last a bit longer. Ethereum, on the other hand, any closure for me for Ethereum under this low, 3750 area, will mean that I'm going to go for a short position on Ethereum. And where will I be targeting? I'll be targeting firstly $2,000 Ethereum. The reason being, we have had two acceleration gaps right over here, one fair value gap here, one here, and the targets for those fair value gaps fall exactly in that region. So if we go for an extension, we will see the extensions fall in this area. So that is what I'm targeting for. If there is any closure underneath it, that's a short for me. Looking at Solana is in a massive consolidation on the weekly time frame. And I just have a feeling we are just entering a phase that we had on BNB, where we went into a consolidation for around 4 years, just didn't break out of it. I just feel Solana is going to do that same thing. We are going to end up in a massive consolidation, and then we'll see a breakout maybe a few years from now. Could I be wrong? Of course. But this consolidation has already been on for around 2 years now. So we are in October. Started off in March. So 1.5 years of consolidation. Can this last another 1.5 years? Yes, it can. And that's what I am trying to play right now. We could go higher, sweep the liquidity, come back lower. That is what my play on Solana will be until we break these highs and try to create a new all-time high. Till that happens, Solana is in a very long consolidation and you should treat it like that. Liquidity hasn't vanished. It's hiding. Debt hasn't broken the system, it's redefining it. And politics haven't killed the markets, they have taken control of them. We are transitioning from artificial liquidity to selective liquidity, where capital still exists, but it's guided by incentives, policies, and fear. So when you trade this environment, remember, don't chase the direction, track displacement, because every cycle ends with the same way. Money doesn't leave it, it rotates. Liquidity is rotating, not leaving.